Welcome to Invested Insider, your trusted source for the latest financial news and insights. My name is Jason Reynolds, and today is the 7th of June of 2023. Let's talk about the roller coaster that is the market today. Our financial headlines were filled with the news of the S&P 500 index firmly stepping into the bull market territory, having risen by an impressive 23% from its October 2022 lows. That's right, despite a lower than expected ISM services figure for May, the market is bullish, but this news should be taken with a grain of salt. Investor sentiment is anticipative of the Federal Reserve maintaining its current rates at the forthcoming meeting on June 14th. As it stands, the likelihood of a rate hike seems to be dwindling, with market indications suggesting a slim 23% chance. However, our market spectators have flagged caution, pointing out that this rally seems to be heavily dependent on a small group of tech mega giants. Lisa Chalette, the wise chief investment officer at Morgan Stanley Wealth Management, has warned of a concentration risk in the main stock indexes, thanks to an exuberance around artificial intelligence and a resurgent U.S. dollar. But let's dissect this a bit, shall we? Is the market's reliance on these few companies necessarily a bad thing? It appears that history might be on their side. These powerhouse companies have been the primary drivers of market upside in the past. And when their relative performance wanes, the broader market has generally stayed robust. So perhaps this narrowness isn't all bad. That brings us to the heart of our discussion today. With the S&P 500 rally topping 20%, are we in a new bull market, or is this just a rally within an ongoing bear market? Let's dive into this conundrum. On one hand, the case for a bull market is supported by traditional definitions and the time since the last market low. Not to mention our beloved fear index, the VIX, is unusually calm, and earnings forecasts are looking favorable. But perhaps the most crucial indicator is investor sentiment, which currently carries a strong bullish flavor. Yet, there's a flip side to this coin. The case for a bear market rally raises several noteworthy points. First, our current market valuation is incredibly high. Then there's the issue of a narrow market breadth and the much-discussed anticipated recession. Lastly, the market looks overbought, signaling potential frothiness and an impending sell-off. So, where does this leave us? The future of the market remains in flux. It's important for investors not to fall into the trap of believing that U.S. stocks will simply continue to rise just because they've seen a 20% surge from their low. In such uncertain times, it's essential to stay informed and make well-thought-out investment decisions. Always remember, in the world of investments, nothing is as straightforward as it seems. As always, do your research, stay informed, and approach any investment decision with care. Thank you for joining us. Stay on top of the waves of change. And until we meet again, nurture your financial future with care.
The Invested Insider podcast does not offer any financial, economic, legal, accounting, or tax advice or recommendations. The information provided in this podcast or on the associated blog should not be construed as investing or financial advice and should not be considered professional advice. The views, opinions, and content presented in this podcast do not represent the endorsement or approval of Invested Insider and assumes no responsibility for the accuracy or completeness of third-party materials or content referenced in the podcast.